Atlassian earnings and the SaaS moat. Let's get right into this. We're looking at a massive market shock coming from Atlassian, which you probably know is the company behind absolute workflow staples like Jira and Confluence. In this explainer, we're going to decode a critical event that is directly challenging one of the biggest narratives in tech right now. No hype, just strictly the numbers and the mechanics of what just happened.
Here's the immediate shockwave. We literally saw a staggering 29% jump in Atlassian stock price in extended trading right after their Q3 earnings report dropped. I mean, in a market that's been incredibly volatile lately, a single-day swing of this magnitude for a major enterprise software company, that absolutely demands our immediate attention. It's signaling a fundamental repricing of expectations across the board.
But to really understand why this matters, you've got to look at the context leading up to that jump. Right before this earnings release, Atlassian stock had actually been down 31% year-to-date. And this wasn't just some minor dip in an otherwise healthy chart. This reflected deep, systemic market pessimism about the company's future and really the enterprise software sector as a whole. Investors were basically pricing in a slow, inevitable decline.
So that brings us to the central mystery we're going to unpack today. Does this sudden, violent upward anomaly prove that deeply embedded software companies actually have a durable moat against the AI revolution? Because, everyone just assumed artificial intelligence was going to eat traditional software as a service, or SaaS. But this earnings report, it strongly suggests we might need to completely rethink that entire thesis. Section 1. The AI disruption fear.
To really get why this earnings beat was so shocking to people, we first have to understand the SaaS-pocalypse thesis that caused all that initial market panic. For months, the prevailing fear on Wall Street has been that traditional software companies are essentially sitting ducks, just waiting to be rendered obsolete. The fear was that foundational AI models from companies like Google and OpenAI are just going to commoditize expensive tools like Jira. The logic is pretty straightforward. Why pay hundreds of dollars per seat for complex project management software if you can just use natural language chat to have an AI agent manage projects, write your code, and update tickets at a fraction of the cost? Wall Street was absolutely terrified of this scenario. The assumption was that AI would seamlessly unbundle these massive platforms, stripping away their high-margin subscriptions overnight. And that very specific threat of unbundling is exactly why Atlassian was down 31% in the first place.
Section 2. Decoding the earnings beat. Let's look at the raw Q3 financial data because it completely shatters that AI disruption narrative we just talked about. Look at these objective facts with me as reported by CNBC. The market expected Atlassian to bring in $1.10 billion in revenue for Q3. What did they actually deliver? $1.19 billion. Adjusted earnings per share were expected to be 62 cents. They delivered 84 cents. So this isn't just a slight edge over expectations. This is a massive, definitive beat across the board, completely defying every single bearish projection analysts had modeled out.
But here's where it gets really fascinating. Now, Atlassian is certainly investing in its own native AI features. You've probably seen them branded as Atlassian Intelligence, but that isn't actually what saved them this quarter. The real growth engines? A 36% year-over-year boost in cloud revenue and an incredible 47% spike in data center revenue. It's their core infrastructure products that are driving the bottom line right now.
Now, if you're a skeptical analyst, you might be raising an eyebrow right now. You might be thinking, wait a second, isn't a 29% jump a massive overreaction? Aren't these cloud and data center numbers basically just different ways of forcing the exact same old software onto users? Well, it's a totally fair question to ask if this is just a temporary relief rally. But the crucial point is, no, this actually fundamentally changes the story. By aggressively pushing customers off their old self-hosted server products and onto modern cloud and data center platforms, Atlassian is actually proving massive long-term ecosystem commitment from their users.
This tells us a lot. It tells us that customers aren't fleeing to cheap AI alternatives. Instead, they're choosing to integrate themselves even more deeply into Atlassian's ecosystem, and they're accepting the higher costs of migration to do it. They're doubling down. And that profound commitment from their user base is exactly what drove this revenue beat of nearly $100 million.
Section 3. Winners and Losers.
So, let's zoom out and look at the macro market implications. When a bellwether company like Atlassian posts numbers like this, it sends a ripple effect across the entire software industry. We really need to identify who benefits from this flight to quality. The clear winners here are deeply entrenched enterprise SaaS giants. Think of companies like ServiceNow and Salesforce. This signal gives them a huge boost because they can argue that they possess the exact same workflow and data mode that Atlassian just demonstrated. The losers? Well, first, the short sellers who bet heavily on the SaaS-pocalypse, and second, AI-native point solutions. This is a pretty harsh reality check showing that a cool standalone AI feature simply isn't enough to unseat a platform that already acts as the central nervous system for an enterprise.
Section 4. Blueprint or temporary relief.
However, we always have to run a critical risk check. Is declaring the SaaS apocalypse entirely over a bit premature? We need to look at the potential headwinds and objective limitations here. Let's detail the caveats. First off, Atlassian's Q4 revenue guidance came in at a modest $1.12 to $1.135 billion. That isn't a blowout, which suggests growth could easily moderate in the near term. Second, forcing customers to migrate to the cloud is a card you can really only play once, right? It has finite limits. And finally, the evolving threat of AI agents isn't gone forever. A Jira killer might not exist today, but the fully autonomous AI agents of 2027 or 2028, those might pose a much more existential threat to these business models down the line. Section 5. The Data Gravity Moat.
This brings us to the core insight of this explainer, directly answering the central question we posed at the start. How exactly are these legacy SaaS companies defending themselves right now? Well, here's the winning blueprint they're utilizing. Step 1. You have a massive user base originally set up on old on-premise servers. Step 2. You use price adjustments and end-of-support policies to basically force a cloud migration. Step 3. Once those users are inside your multi-tenant cloud environment, you achieve data gravity. This workflow stickiness turns the platform into an absolute gatekeeper. It consolidates the vital corporate data that AI tools desperately need to access, which means the AI ultimately has to play by Atlassian's rules. It's brilliant.
So the absolutely crucial point for analytical investors and operators is this. Ignore the AI buzzwords on the earnings calls. The real signal is right here. Watch the cloud net revenue retention. Focus strictly on migration and platform adoption metrics. That is exactly where you measure the actual thickness of the defensive moat. If they keep the data, they keep the leverage.
Let's break down the practical applications of this market signal. If you're an investor, actively check migration metrics in upcoming earnings for comparable companies like Asana or Monday.com. If you're an operator currently relying on on-premise tools, expect your vendors to force a cloud shift. It is their primary survival strategy right now. And if you're a builder,
Your mandate is crystal clear. Integration, not replacement. A frontal assault on embedded workflow tools using AI is highly unlikely to succeed right now. The winning move is to build AI layers that work securely with the data already inside these sticky platforms, rather than trying to rip the enterprise users away completely.
Section 6. A blueprint for survival. To summarize our final judgment, Atlassian isn't just passively surviving the AI wave. They are actively using the AI threat as a catalyst to aggressively consolidate their users and strengthen their defensive moat through data gravity. But I want to leave you with a provocative thought to consider. Based on the hard numbers we've explored today, what is your judgment? Is Atlassian's successful cloud migration proof of a truly durable moat for SaaS? Or is this massive stock jump just a temporary reprieve, like a final victory lap before AI agents become sophisticated enough to unbundle these platforms for good? Let us know what you think.